Who actually buys whole life insurance? Hi, I'm Brandon, founder of the Insurance Pro Blog and licensed insurance agent, and I've sold hundreds of whole life insurance policies, so I have a pretty good idea of what motivates people to buy whole life insurance, what it is they're specifically looking for when they are in pursuit of one of these policies. And it also happens to be the case that I have a somewhat unique position of selling policies to people who come to me looking for them rather than me going out and trying to drum up interest in the product. So having done that for quite a number of years now, I've definitely gathered a sense of what is moving these people to be in pursuit of whole life insurance. To start, there are two primary reasons somebody would look to purchase whole life insurance. So one motivation would be establishing a permanent death benefit. The other motivation to buy whole life insurance is to benefit from the cash accumulation feature of the product. Now, in general, it is advisable that you pick one of these two motivations and make it your primary focus, because trying to buy whole life insurance that is both really good at giving you permanent death benefit and really good at providing you with a high rate of return on the cash value accumulation is probably going to result in you being woefully disappointed in both results. When it comes to the way whole life insurance policies are manufactured by life insurance companies or specifically designed by life insurance agents, we can maximize one of those two features, but not both. Now, it doesn't mean that the other lesser optimized feature is going to be horrible. It just means that when we try to split between the two, we get a result where both are a little washed out in terms of their total potential. So pick one and target it, and you will probably like what the whole life policy brings to you a whole lot more. Let's start with the consideration for permanent death benefit, because it is the arguably simpler, at least to understand, motivation to buy whole life insurance. There are a number of reasons why somebody would want permanent death benefit. The most commonly discussed motivation to establish a permanent death benefit generally involves paying for transfer taxes. The most common one discussed is the federal estate tax, though there are certain states that have their own estate taxes to handle as well. In addition to federal transfer taxes, people also sometimes worry about the affordability of income taxes that might be due on qualified accounts that they plan to leave to their children. One motivation or strategy might be to take withdrawals from, let's say, your IRA and pay taxes at a lower rate that you would be subject to, take those funds and buy permanent life insurance so that you can then leave the tax-free death benefit to your children. This is especially a big motivation for parents who have very high income earning children. Another motivation for permanent death benefit is estate liquidity. And while taxes can absolutely play a role in the strategy of estate liquidity concerns, they're not exclusively the chief concern for estate liquidity. When you die, your money is not always immediately accessible by the people who are going to be settling your estate. So having some form of cash available to pay for ongoing maintenance things is mighty helpful for whoever is overseeing the distribution of your estate. For example, if you own real estate and you intend to leave that real estate to, let's say, your children, and their plan is to simply sell that real estate and take the cash, there are likely going to be expenses that they will face while they wait for things to get taken care of. First, the probate process has to unfold unless the house is sitting in a trust. And then even if it is in a trust, we need to go through the process of actually selling the house. And real estate typically comes with a certain amount of carry costs. These could be things like the property taxes that may be due on the house, certain utilities. If you live in the Northeast like I do and die in the winter, somebody's going to have to pay for the fuel to heat the house. Life insurance is a way to create the cash that will be necessary to cover these costs in the meantime. For some people, there's a focus on inheritance that life insurance can certainly complement, if not significantly augment. Some of the most basic examples involve people taking cash that they have on hand, using it to buy a life insurance policy so that they can augment the overall amount that will be left to, let's say, their children. To be honest, that situation I don't see happening all that often. But more commonly, the use of life insurance as a tool to bolster inheritance is often used in coordination with other planning mechanisms, usually ones that somebody takes advantage of from a tax savings perspective while they're still alive. Charitable remainder trusts are an excellent example of this. In those situations, somebody donates highly appreciated assets to a nonprofit and collects an income as part of that donation. And they receive a substantially large tax deduction for the gift. But by virtue of doing this, they've removed those assets from their estate and removed those assets from something that their children will inherit. Buying life insurance is a way to recoup the value that was donated to the nonprofit. Couples who rely more significantly on Social Security income may also have a significant need for permanent death benefit. While married couples can choose to receive the higher spousal benefit when one of them dies, non-married couples don't have this option. But even if you do have the ability to switch to a higher Social Security benefit when your higher income earning spouse passes away, you will lose some of the income that you had. And if Social Security is playing a substantial role in your retirement income plan, this might be problematic. I can speak from a lot of experience when I say that a number of people have come to us looking to buy permanent death benefit because they understand the loss of income their spouse faces if they die because of the change in income that will result from Social Security benefits. And if you have a special needs child, having life insurance is critically important. And because you don't necessarily know how long your commitment to that child will last, permanent death benefit is a much simpler way of ensuring you never have to worry about a term policy expiring. Now, when it comes to cash value focused purchases for whole life insurance, generally speaking, the right way to think about this is the establishment of a low risk asset with a relatively high rate of return given the risk profile. The cash accumulation of a whole life insurance policy will behave much similarly to bonds in terms of expected rate of return, but it provides substantially higher amounts of liquidity with also greater degree of stability when it comes to month-over-month price, because bonds can fluctuate in the value that you could sell them for, and bond funds will absolutely fluctuate as a result of this. But whole life insurance cash values do not fluctuate, meaning you don't have to worry about having to sell or being in a position where you need to sell at the wrong time because the value of your bonds has gone down. Additionally, the stability that whole life insurance has inherent to it contractually makes it a very strong source of predictable and reliable income. But, and this is important, whole life insurance is not the panacea, contrary to what some very aggressive life insurance agents might be telling you. There are some who way overstate the benefits of having cash value inside a whole life insurance policy. And while there are definite benefits that it brings to the table, it is not going to solve all your problems. It's not going to make you fabulously wealthy, and it's not going to beat the stock market. It's a low-risk asset allocation, and it's a very good low-risk asset allocation. But that is the limit that you have to keep in mind when it comes to the cash accumulation of whole life insurance policies. Some people foolishly compare the rate of return of whole life insurance to stocks, and they try to massage the expected rate of return through various qualifiers like taxable equivalent yield. And while I don't want to leave you with the impression that I think those are unimportant considerations, the likelihood that taxable equivalent yield on the cash accumulation of whole life insurance is going to substantially outpace the overall rate of return after having to pay taxes, if you do, on stock-based investments that you make is simply not that high. The two work well together. They are not substitutes for one another. In general, people who prefer whole life insurance are more conservatively minded individuals when it comes to their investments. These are people who tend to be relatively risk averse. And in some cases, the appreciation of what whole life brings to the table forms for a number of people as they get older. This happens because with age comes a certain amount of experience that shows you that maybe you're not going to get the rate of return that you thought you were going to get in stocks. Or perhaps you find yourself in a position where you have a pretty substantial amount of money, and now it's not about getting more, it's about trying to preserve what you have. The very, very consistent rate of return nature of whole life insurance and moderate year-over-year growth is something that shines very brightly for people in those situations. But this is something that often gets ignored by younger individuals, and especially people who are much more risk-seeking when it comes to their investment behavior. There's also, oddly, a group of people out there who have a certain amount of machismo over their perceived ability to not have to own life insurance. It's sort of this, I've made so much money or saved so much money, I don't need to have life insurance, which for a large number of those individuals is probably a foolish outlook on what insurance brings to the table. And there are certainly ways that you can incorporate permanent life insurance into your plan, even if you feel like you don't need life insurance per se, to significantly augment your net worth. But certainly this is a product that is more attractive to individuals with a more conservative investment risk appetite. In other words, whole life insurance is a much better wealth preserver than it is wealth creator for most people. There are a few caveats to that when it comes to what one might actually do with the cash value that accumulates in their whole life insurance throughout the years of their life. But for the most part, people are going to use whole life insurance as a way to store the successes they've already had and grow that money more moderately than they did in years past. And for that reason, it's understandable that whole life insurance will be more attractive for individuals who are a little bit more advanced in age. This doesn't mean that young people should ignore whole life insurance completely. It just means they shouldn't hyper concentrate on it, because it's likely that there will be other things that they can invest in that will be more meaningful, at least for a period of time, until they get a little older. But admittedly, I will tell you that we have clients who bought whole life insurance in their 20s and 30s, and some of them now have 6- and 7-figure cash value balances inside their whole life policies. They're certainly not upset with life. But I'd also be remiss if I didn't point out that most of those people were already on a pretty good trajectory in their life. And in general, whole life insurance doesn't make people much wealthier, but it often makes people who are already on pace to be high net worth or are high net worth just live even more securely. Now, there are some unique leverage opportunities with the cash value that accumulates inside whole life insurance. There are entire kind of subcultures that exist in the life insurance world that dedicate themselves to talking about the cash in your life insurance policy as your own personal bank that you can use alternatively to financing as a way to gain an advantage over what you would lose in terms of interest paid if you just went out and financed things. There are shreds of truth to this. Some take it a little bit extreme, but we have certainly helped people implement similar ideas to great success when it comes to business opportunities, business building, and wealth building in general. You'll often hear the term dry powder thrown about in these circles. It basically just means cash on hand to take advantage of opportunities. And since whole life insurance has cash-like liquidity but bond-like returns, it is a pretty good mixture of a place to store cash at a higher rate of return than you'll get most of the time in a simple savings account, but you'll still maintain that quick liquidity that's necessary to access the funds to do whatever it is you want to do. And the way that whole life insurance cash values grow over time can become significant with regard to the efficiency that's built into the whole life insurance contract as it ages. So even those who buy relatively small policies at a younger age find themselves in a position where the rate of return they're achieving on their policy as they get into their 50s or 60s is actually quite impressive. Now, does this mean that everybody out there should buy whole life insurance? No, it does not. There are certain attributes that you may hold that would make you a really poor candidate for whole life insurance. It's still life insurance. You got to be healthy enough to actually qualify for life insurance. You also need to not have risky avocations that are going to result in punitively higher expenses for your whole life insurance policy. So if you are not in great health, or you happen to do a lot of deep sea diving or auto racing or mountaineering, there are prohibitive aspects to things you do on the daily that will make your life insurance contract less conducive to accumulating cash value. Now, if you're healthy and you don't have any of those activities that you engage in, you don't have this problem. It's also important to understand that correct execution is paramount for success. You can't assume that whole life insurance is whole life insurance is whole life insurance. The product is actually extremely versatile, and the right product selection is not easily understood by the layperson. And for this reason, some people decide to skip whole life insurance entirely because they think it's just too complicated and far too risky to end up with the wrong thing. That's fine. I totally understand that sentiment. But there are those who will work through the details to find what's right for them, and we've seen a lot of success with happy people. There are some arguments that you could accumulate cash value in a whole life insurance policy and then choose to pursue whatever kind of other investment activity you are going to target. And while this is conceptually sound, I can tell you practically speaking, it's much easier said than done. So the best way to approach whole life insurance is first to understand what your objective is. If it's death benefit, that means you're going to be focusing far less on cash value. There are a wide array of reasons people might want or need permanent death benefit. And it is helpful to have, and also keep in mind that life insurance is always harder to get as you get older because there's a lot more chances that some sort of health item will develop that'll make it more expensive to buy life insurance or not even available to you. But you do have to balance the process of purchasing it way sooner than you need it. Even if you do believe you will have a permanent need for death benefit, trying to put together the money and foregoing other investment opportunities when you're in your 20s or 30s may be detrimental to your overall wealth building capabilities. It's also worth knowing that if you do think you need permanent death benefit and you buy a whole life insurance policy, but find yourself in a position several years later where you decide actually you didn't need to own permanent death benefit, you could cash in the policy for its cash surrender value, but you can also sell a whole life insurance policy for some value that is more than the cash surrender value of the policy. For those who are foregoing permanent death benefit, but focusing a lot on the cash value accumulation aspect of a whole life insurance policy, they're doing it primarily because they want a low risk asset with a relatively high rate of return given the risk profile. The typical expected rate of return of a cash-focused whole life insurance policy falls somewhere in the range of 4 to 5% compounding annually. Whole life insurance, because of its stability, will also provide a slightly higher withdrawal rate than we would normally expect from a stock bond portfolio, generally 5% over 4%. It's not going to alter the course you're on when it comes to wealth accumulation, but it is going to help you preserve the wealth that you've built. And as a low-risk asset, possible alternative to bonds, it is a fantastic complement to other higher risk assets like stocks, commodities, cryptocurrency, and real estate. It works as a fantastic complement in those situations because when those assets turn negative, you at least have a strong cash position in whole life insurance to fall back on momentarily while you try to regain the losses from the other riskier assets. And for individuals who are looking for a diversified income strategy, again, the stability that whole life insurance brings to the table provides you with yet one more leg that you can stand on for income capability that is generally unaffected by business cycles and also unaffected by tax policy changes.